This ETF is looking really interesting right now. So first off, read this disclaimer carefully. Then do your good deed of the day by liking and subscribing. So we are in the consumer defensive space, global agribusiness. 2% from the 52-week low, 18% away from the highs. So the ticker is VEGI. We start here with the weekly data points. And we do go pretty far back here. We can go back to 2012, and you can see that there have been some pretty substantial time cycles. Differed a bit in duration. The C19 in lockdown was a bit of a disruption, but based on the time cycles, we sort of expect the declining, major phase to be toward its end. Something that is very interesting is that when you look at support, let me draw that in. You see that the red 200-week moving average, support, 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 and it recently was support again. So that is a pretty interesting level. So in terms of a stop loss level on the weeklies here, we are talking about, 2.5%. Not too shabby. Here are the daily data points. In this case, you could certainly make the case that this looks like a double bottom. Also a pretty interesting technical level. So this one it really is at a nice entry. Looking at the RSI and the PPO, we did bounce from a recent RSI support level. That's also, bullish. Looking here at the dailies, the bulls have been, into action a bit now. So timing is not perfect, but it's not too bad either. It's sometimes it's beneficial to also have some confirmation, and in this case, this is the first week we are actually above the red 200-week moving average. What I don't like though is the wicks. You see that the wicks last week way higher but closed lower. In this case, you do have a bit of an inverted hammer so far. Not ideal. It shows that there are bulls, but they are sort of lacking when it comes to confidence. We do prefer our bulls to be a bit more confident than this, but we do have a 200-week VMA support. I do think I will give the bulls. I give them a 5. I wish I could give them higher, but basically because the bulls are being too skittish to really warrant any kind of higher score than that. But overall, decent. On the seasonality, that is where we do see it's a bit messy to the left here. A very strong seasonality here, but that is in towards this December, beginning of next year. Looking at the table view for October, so far we have a loss, but generally speaking, October tends to be bullish. Only really 2018 was a bad October. November, usually pretty green. December mixed, and January is overall pretty green. So the seasonality for this space is pretty good. I think I will give it a 6 here on the seasonality. Now let's look at the fundamentals. We are comparing VEGI against the SPY. So let's look at performance first. So year to date, VEGI is substantially underperforming the S&P 500, but that could also be a case for a rotation. Beta is lower at 0.87. We see that the PE is 10.18 versus 17.86 for the SPY, so that's a massive difference. Yield 2.16 in favor of VEGI and 1.51 here on the S&P. Looking at the holdings. So here you can see process industries is the biggest. Producer manufacturing, non-durables. So yeah, I mean, this one is pretty interesting when it comes to these fundamentals. So I do think I will give the fundamentals here an 8. This is a lot of value. So next we will do some statistical analysis. Let's have VEGI here. We want to compare it against the SPY. We might actually also compare it against, let's take VT. That is the total stock market index. And we can also compare it against MOO. MOO is the agribusiness ETF from VanEck. So these are long-term correlations, 36% with S&P 500, 10% with VT, 82% with MOO. On the dailies, we are at minus 6% with S&P 500, 13% with VT, 98% with MOO. So definitively, what happens with MOO is going to have an effect on the VEGI. So you can see that MOO has definitively corrected very substantially. So let's look a bit at RSIs. Yeah, it is also at an RSI support level. On the dailies, the bulls have fought a bit, but also they have a lot left to prove. Seasonality. Looking at the table view, October is okay. November is pretty strong, going all the way back here to 2012. So that is bullish. Not super bullish, but bullish. So let's now compare VEGI with the MOO, like that. Enter. So VEGI, it is outperforming MOO. But as we saw, VEGI is not like an overvalued ETF at all. So in this case, it is outperforming, but we could start to talk about a potential breakout in development. RSI is a bit higher than I would like it to be. On the dailies, it is pushed a bit against the MOO. Let's look at the seasonality. So VEGI does have a bit of a tendency to weaken against the MOO into mid-November here to the left. On the table view on the right, October is, generally speaking, a bullish month for VEGI. It usually outperforms the MOO. November, at least after 2018, which is most relevant to us, it outperforms, and December is very strong in favor of VEGI. So overall, I do think that the seasonality here is pretty good. So I think I will give the bulls, I give them a 5 on relative performance here. So we do end up with a 6 in favor of the bulls overall. We are at the 200 weekly moving average support. And you can be fairly strict with the stop loss level, given that we have a clean support level. As we saw with some of the previous weeks, there's been some dabbling below the support level, so maybe not be like super strict, but I do think it's prudent to be somewhat strict when it comes to a support level. So yeah, the interesting thing about this sector is that when we saw the correlations with the S&P 500, it sort of lives in its own bubble, and that can be very beneficial in a market-neutral portfolio. Another thing about agriculture is that when we talk about finance, this is like the OG financial space. Long before the stock market and stuff like that, people traded commodities. People traded agricultural products like cows and hides and all kinds of stuff, corn, you name it. So that is where it all began. So it's pretty cool to see that even in our modern times, this sector, it still is something quite distinct from the stock market, which we saw with the correlations. So yes, I think the way I will gain exposure to this is with the ETF. And when it comes to commodities, of course, you have the futures market, which is more like directly getting exposure to the commodities. When you look at companies that have exposure to the commodity sector, it's one step beyond the commodity itself, and that has all kinds of pros and cons. When it comes to investing in commodities, especially the futures market, then that is something that it's a completely different animal, especially when you look at the leverage and also the extent to which you have to manage the position. So this ETF, it gives you exposure to companies, and a benefit with that is that you don't get that divergence between the ETF and the commodity that you get with those ETFs that try to give you exposure to the actual commodities, because then they can have all kinds of tracking errors. So yeah, stay tuned for more and have a great week ahead.